Topic introduces the principles of fixed income bond valuation and explains the relationship between bond prices and yields. Bond valuation involves determining the present value of expected future cash flows, including periodic coupon payments and repayment of principal at maturity. Because bonds represent contractual obligations with relatively predictable cash flows, valuation relies heavily on discounting techniques using market interest rates. Investors compare a bond's coupon rate with prevailing yields to determine whether the bond trades at a premium, discount, or par value. Understanding bond valuation is fundamental because changes in market interest rates directly affect fixed income prices, portfolio performance, and investment decision-making in global capital markets. The value of a bond equals the present value of all future cash flows discounted at the bond's required rate of return, commonly called yield to maturity or YTM. Coupon payments are discounted individually according to the timing of each payment, while the principal repayment is discounted over the full life of the bond. If the coupon rate equals the required yield, the bond trades at par value. When the coupon rate exceeds market yields, the bond trades above par because investors value its higher coupon payments. Conversely, if the coupon rate is below prevailing yields, the bond trades at a discount to compensate investors for lower periodic income. Yield to maturity represents the internal rate of return investors earn if they purchase a bond at the current market price and hold it until maturity while receiving all promised payments. YTM assumes that coupon payments are reinvested at the same yield and that the issuer does not default. Because YTM reflects both coupon income and capital gains or losses from price changes relative to par value, it serves as a comprehensive measure of expected return. Bond yields and prices move inversely. When market yields rise, bond prices fall, and when yields decline, bond prices increase. This inverse relationship is a core principle of fixed income analysis. The topic also explains how bond prices are determined on or between coupon payment dates. When bonds trade between coupon periods, buyers must compensate sellers for accrued interest earned since the last coupon payment. The quoted bond price excluding accrued interest is called the clean price, while the full transaction amount including accrued interest is the dirty price or full price. Accrued interest is calculated based on the day count conventions specified in the bond contract. Understanding clean and dirty pricing conventions is important because bond market quotations typically use clean prices, whereas settlement amounts paid by investors include accrued interest obligations. Several factors influence a bond's sensitivity to changes in market yields. Bonds with longer maturities generally exhibit greater price volatility because investors wait longer to recover principal repayments. Similarly, bonds with lower coupon rates experience larger price fluctuations because a greater portion of their value depends on distant cash flows. Market yields also affect sensitivity. Lower yield environments produce greater percentage price changes for a given shift in rates. Consequently, long-term, low-coupon bonds carry higher interest rate risk than short-term, high-coupon securities. These relationships help investors evaluate duration exposure, manage portfolio risk, and anticipate the impact of changing interest rates on fixed income investments. The program further introduces matrix pricing, a technique used to estimate the value of bonds that trade infrequently or lack recent market quotations. Matrix pricing determines a bond's estimated yield by comparing it with actively traded securities possessing similar characteristics such as maturity, coupon rate, and credit quality. Once an estimated yield is identified, the bond's price is calculated using standard present value methods. This approach is widely used for valuing less liquid corporate and municipal bonds where observable market prices may not be available. Matrix pricing improves valuation consistency and supports portfolio reporting, risk measurement, and performance evaluation within institutional investment management. The term structure of interest rates also plays an important role in bond valuation. Bonds with different maturities generally offer different yields because investors require compensation for varying levels of risk and uncertainty over time. Yield curves graphically represent the relationship between maturity and yield for bonds of similar credit quality. An upward sloping or normal yield curve indicates higher yields for longer maturities, reflecting expectations of greater inflation or economic uncertainty. Inverted yield curves may signal economic slowdown or anticipated declines in future interest rates. Analysts use yield curves extensively to assess relative value opportunities, forecast economic conditions, and evaluate fixed income portfolio positioning. Topic ultimately demonstrates that bond valuation is central to fixed income analysis and investment management. Accurate valuation requires understanding discounted cash flow principles, yield calculations, accrued interest conventions, and the relationships among coupon rates, maturities, and market yields. Because interest rate movements directly influence bond prices and expected returns, investors must carefully assess duration exposure and market conditions when constructing fixed income portfolios. Techniques such as matrix pricing and yield curve analysis further enhance valuation accuracy in complex markets. Mastery of bond valuation concepts enables analysts to evaluate investment opportunities effectively, measure risk, and make informed portfolio decisions within global fixed income markets.